We're joined by the Director of U.S. Rates Strategies for Credit Suisse Securities USA's Ira Jersey. Ira, good to have you here. Ira, do you find it a bit mind-boggling that the bond vigilantes haven't kind of kicked in and forced up rates here on Treasuries?
Well, not really, because we don't know where they would go. You know, you can't go to Europe now. It's hard to find appealing rates in other countries or liquid enough markets for you to go into. So while there might be some alternatives, those markets tend to be relatively small, which is also why they have very good ratings. But there's also a liquidity issue. The U.S. Treasury market is still the most liquid market in the world, and no one is really expecting an actual default or missed coupon payments. And I would note this, that even though you're not seeing this in yields, you look at things like credit default swap spreads for the U.S. On the U.S. government securities, they are edging a little bit higher, and I think that's where you're seeing some of the concern taken. So if you look at where credit default swaps for 1-year CDS were back in May compared to today, they're triple. So you can't say that there's no one spooked, but at the same time, it's not in cash securities. Right.
It's definitely not being priced in the market. But as Sarah pointed out, if we get a default come August 2nd, Ira, I mean, could we see some dramatic market action?
Well, you could. I don't think we're going to see a default on August 2nd. In fact, rolling over of Treasury bills would be the first thing that would occur. Those settle on the 4th, on Thursday, the 4th of August. But it's really the August 15th coupon payments that are most at risk. We did an analysis last week in our weekly publication where we noted that the only realistic way in order to make those payments were to be to default on something else. So if you close down 85% of the government, only paid 40% of Medicare and Medicaid, paid all of Social Security, then you could pay. Then you'd be able to pay coupons. So it winds up being a very drastic cutting of the deficit. But at the same time, you know, there's $31 billion of coupon payments that need to be made August 15th. The government's going to take in something like $175 billion in revenue during the month. So your interest payments to revenue still match up.
Got 45 seconds for you, Ira. So where do you see rates going? 288 on that 10-year today. I mean, I thought we would be well above 3% by this point. Where do you see rates going, and what's your advice to investors, just quickly?
Well, so much of it is the uncertainty, particularly about Europe and about this debt ceiling issue. I think if we get some of that uncertainty resolved, so we get some kind of deal in Europe in the next week or two, then we're likely to see higher rates. In fact, by the end of September, we're expecting to see about 3.35% on the 10-year.
Going to leave it there. Ira, good to get some time with you.
Thanks,
Ira
Carol.
Jersey joining us on this Monday.